Good morning or afternoon, depending on where you're joining us from today. My name is Edward Redder, and I would like to welcome you to our webinar. I'm a partner in the Employee Benefits Practice area of Thompson Hine's Columbus office. I'm joined today by my colleagues, Dominic DeMatties, a partner in our Washington, D.C. office, and Leah Singleton, a senior counsel in our Atlanta office. Today, we will review the latest updates and guidance related to retirement plans. This webinar is the third in a series of 4 that we've scheduled for each Wednesday at noon during the month of October. Each webinar explores a different benefits-related topic. Please join us every week or just for the topics of interest to you. You can register for additional webinars through the invitation you received or on the Events tab on the Thompson Hine website. Each webinar will offer CLE and a certificate of attendance for those that would like it. I do want to mention one other housekeeping item. Today's webinar is being recorded and will be sent to all registrants within approximately 2 business days. During today's presentation, please feel free to use the question panel at the upper right-hand corner of your screen. We will answer questions at the end of the webinar as time permits. And now we will begin our presentation. Leah, please begin today's webinar.
Thank you, Ed. So the last 2 years have brought us more changes in the retirement plan world than we've seen in a long time. Plan sponsors need to be aware of the changes to make sure their plan documents are updated and to operate their plans in accordance with all of these new regulations and laws. I've had a couple of clients say, with all these changes, what do we have to do by the end of this year? So the first part of this webinar will go through the required plan amendments for 2021. So the next slide talks about the qualification rules for the 2021 year-end plan amendments. One you're probably already familiar with. This came about and has been effective since 2020, but it's the new hardship distribution rules. Your plan may have already been amended for that, but if it hasn't, it needs to be amended by the end of this year. And as any good attorney, I need to add a caveat here that anytime we talk about a deadline for a plan amendment in this webinar, we're assuming it's a calendar year plan. If your plan is not a calendar year plan, you can reach out to your friendly neighborhood Thompson Hine benefit attorney to help figure out when your deadline is. The other qualification rule that has to be done or amended for the end of this year does not apply to many, but if you're a collectively bargained or union hybrid defined benefit plan, there's some market rate of returns that need to be included in amendment at the end of this year. The next slide talks about how a non-safe harbor plan can become a safe harbor plan this year. If you are not a safe harbor plan and you want to become a safe harbor plan, there's still time for this year. In 2021, as long as you have a 3% non-elective employer contribution, meaning the employer will put 3% of a participant's compensation into the plan regardless of whether the participant has contributed or not, you can make an amendment that is effective retroactively back to the beginning of 2021, as long as it's in place 30 days before the end of the plan year, so by the end of November. Under the Secure Act, we also have another bite of the apple. You can amend the plan at any time prior to the end of the plan year, as long as you do a 4% non-elective contribution. So if you miss that 30-day deadline before the end of the year and you still want to be a non-elective safe harbor plan, you can be if you do 4% instead of 3%. So what do we need to do for amending a safe harbor plan on the next slide? So amendments for safe harbor plans, there's a lot of restrictions that prevent a plan sponsor from amending a safe harbor plan mid-year. So if you have discretionary changes or you're putting something new in place and your plan's a safe harbor plan, you need to do it before the last day of this year to be effective next year, January 1st, 2022. There's a few exceptions for that. We've listed them here. reducing or suspending future contributions. In some cases, you can't just stop contributions, and we suggest that you contact a Thompson Hine attorney to help you walk through that if you find you need to stop contributing to a safe harbor plan. You can always put in place a Roth contribution feature or a hardship distribution from Roth. There's a couple of other exceptions in the IRS guidance that we're not going to go through today, but as a general rule, you shouldn't be amending your safe harbor plans mid-year, and any amendments for next year should be made at the end of this year. The next slide talks about discretionary changes for non-safe harbor plans. So if you have changes, amendments that are not required that you want to put in place for this year, they can be effective retroactively back to January 1st of this year, as long as they're signed by the end of this year. So unlike safe harbor plans, we have a little bit of leeway in non-safe harbor plan amendments. The next slide goes through the required annual notices, and this is just a reminder that your automatic contribution arrangement, or ACA, or your eligible automatic contribution arrangement notice, or ECA notice, must be given at least 30 days before the beginning of 2022. Your qualified default investment alternative notice must also be sent 30 days before the beginning of the 2022 plan year, and a lot of plans combine that into a single notice. We also wanted to bring to your attention that under the Secure Act, plans with safe harbor non-elective contributions, and again, non-elective contributions are the employer puts the money into the plan, regardless of whether the participant puts money in the plan. But a non-elective safe harbor contribution of at least 3% of a participant's compensation, those plans are no longer required to provide a safe harbor notice. And the idea or the logic behind that is that it doesn't matter what the participant contributes to the plan, the employer will always put the non-elective contribution of at least 3% or whatever your plan says into the plan. And so the participant doesn't have to have a notice. This is different than safe harbor matching contribution plans. For those plans, you must still provide the notice 30 days before the beginning of the 2022 plan year. Logically, that makes sense. A participant puts money in the plan, the employer matches it. So how much money the employer puts in is dependent on what the participant does to a certain extent, and so they should be getting a notice. There's some language that you can include in these notices that will make it easier to amend a plan mid-year to stop contributing. If you think that that may be of interest to your company, you want to make sure you add that optional language in your notices. Okay, so that's all the requirements for this year. The next slide is going to talk about changes we're going to see next year. Some of these changes have already come about in operation, and they're required to be put into your plan next year, or some of them are operational changes that we'll see next year. One of them is the life expectancy tables for required minimum distributions. Remember, required minimum distributions are the amounts that a participant has to get out of the plan when they reach age 72 or 70 and a half, depending on the date. And so the life expectancy tables used to calculate those amounts are changing for next year. And you're likely not going to need a plan amendment for that. Most of this is just plan administration, but your plan may talk about a table. In that case, it would need to be amended. The result of that, or the impact of this change, is that people will be required to take less out of a plan, and there will be more of the account balance left in the plan. The idea is to keep money in the plan for people's longer life expectancies since the last time these tables were changed. Another operational change or thing you'll see coming up is the new requirement to provide a lifetime income illustration for 401k plans and defined contribution plans. Those have to be provided at least annually in the benefit statements, And that's just supposedly to help the participant understand how much they have at retirement if they were going to receive a monthly amount instead of a lump sum amount. There's also some temporary relief that came about from COVID, that certain plan elections did not have to be witnessed in person. And that relief continues until July 1st, 2022, and then we'll go back to the old rules. On the next slide, we talk about the Secure Act. So the Secure Act was passed. Most things were effective January 1st, 2020. So you've probably already seen these things, but it's not required to be amended for your plan document until the last day of 2022, so next year. Although you certainly can amend it this year if you want. The required minimum distribution age increased from age 70 and a half to age 72, beginning December 31st, 2019. The automatic enrollment contribution for QACAs, which is how much the participant automatically contributes without another election. That maximum increased from 10% to 15%. Again, this went into effect a couple of years ago, but the amendment's required next year. The qualified birth and adoption distributions, this is a new distribution that was allowed from plans if an employer wanted to provide it. They're not required to, but they are allowed, they can amend their plan to allow participants to take up to $5,000 for birth or adoption expenses. It's not subject to the 10% penalty for participants who are under age 59 and a half, and there has to be a recontribution right. Another thing that we hear a lot about is this long-term part-time employees that have to start participating in our plan beginning January 1st, 2024. So if you have part-time employees that work more than 500 hours for 3 consecutive years, beginning January 1st, 2021, they have to be allowed to participate in your plan, meaning they have to be allowed to make contributions. You may have a plan design where you can exclude them from receiving employer contributions. And if that kind of difference is of interest to you, feel free to reach out to one of us and we'll be glad to talk you through it. The main point of that is if you have a large seasonal employee or part-time employee population, you need to be thinking about this now. On the next page, we talk about the CARES Act. The CARES Act were things that were put in place last year during COVID to try to help people during the pandemic. Most of these provisions have become effective and then are not effective anymore, but the plan does not have to be amended until the end of next year if you decided to do some of these things last year. So one is the 2020 waiver of the required minimum distribution, and this only applied to 401k plans, defined contribution plans. Pension plans cannot take advantage of this, but payments that would have been given April 1st, 2020 and 2021 could be waived and did not have to be made. Distributions up to $100,000. Last year, it was optional. An employer could add that to their plan. They could also increase their loan limits from $50,000 to $100,000 last year, and it also delayed and deferred some of the loan repayment rights. There was also a delay in some of the pension plan funding obligations so that contributions due in 2020 did not have to be paid until January 4th, 2021. There was some partial plan termination relief that if your employee population dropped 20% or more, then there was some relief on that. Again, most of this relief has already stopped, but the plan amendment's not required until next year. The other good thing we saw this year was some EPCRS changes. The EPCRS stands for the Employee Plans Compliance Resolution Systems, and it's a program the IRS puts out that explains to plans some methodologies and procedures to correct plan errors. If you have a retirement plan, you've probably utilized it. If you haven't utilized it yet, I bet you will in your career at some point. But the IRS came out and expanded some relief mainly for overpayments. They gave different ways to correct the situation where you overpay too much to a participant so that you're not demanding that money back from the participant. They gave other ways to correct that error besides demanding the money back from an individual. Another significant change that was good news to us is in the past, if you had a significant failure, it had to be corrected no later than the second plan year after the failure. Otherwise, you had to submit and apply to the IRS for permission to correct under this program. And the new changes extended that to 3 years instead of 2. There were a couple of other changes that are helpful, but we just wanted to, instead of going through all the details of these changes, because there's so much other cool stuff to talk about, we just wanted to just raise your attention to the fact that there are some changes, and if you need a plan correction, we'll be happy to talk through any of the details with you. So Ed, I'm going to turn it back to you.
Excellent, thanks, Leah. So we're now going to shift from IRS and qualification requirements to the fiduciary side of the house. So hardly a day goes by these days where there's not a headline or a news story about some significant data breach for a large company or for even the government for that matter. And with trillions in assets, retirement plans have really become a rich target for hackers. And this is really heightened, this issue is heightened because of the way 401k plans work, right? We have individual accounts with possibly thousands of participants that can log into their account on a daily basis and perform transactions. And so this is a real risk, and that's why 401k plans are particularly vulnerable in this area. And again, the risk is not abstract. We have seen cases filed over the past couple of years focusing on theft, essentially, right? Somebody has accessed an account, a bad actor has accessed an account, either due to lax security or otherwise, and has been able to essentially steal money from a participant's account. While we've all recognized that these are significant risks and have been around for a while, until very recently, the Department of Labor has been nearly silent on the issue. And in fact, the Government Accountability Office issued a report just earlier this year entitled Federal Guidance Could Help Mitigate Cybersecurity Risks in 401k and Other Retirement Plans. And it specifically noted in this quote below that the DOL has just simply not established minimum expectations for protecting PII and plan assets. Well, basically 2 months later, we did finally receive that guidance from the Department of Labor. On April 14th, the DOL issued really long-awaited guidance, and overdue guidance, in my opinion, on cybersecurity and retirement plans. The guidance really consisted of 3 what they called best practices documents. 1, cybersecurity program best practices for service providers. So think of your large record keepers, your trustees, the ones that are actually processing distributions and claims on a regular basis for your plan and other service providers. And these best practices really go kind of soup to nuts, what a service provider ought to be doing, or at least in the department's view, what are the best practices for those service providers. Second, we have tips for plan sponsors to hire service providers with strong cybersecurity practices. So again, think about the fiduciary for your plan. We always have an obligation to prudently select and monitor our service providers. These tips give us helpful tools and expectations of the Department of Labor when we're going through that process of hiring service providers. And then finally, and I think this is maybe the most important piece, is online security tips directed at plan participants to safeguard their accounts, right? We always have to worry about the weakest link. And participants who are not involved in this on a daily basis and who are accessing their accounts and may be relaxed on security processes, can be the weakest link at times. And so these online security tips really do provide helpful advice to participants on what they can do to kind of mitigate the risk of cybersecurity threats. You know, one of those tips is, you know, use multi-factor authentication or activate it, and also to actually go online and establish an online account, because a lot of participants don't do that. If they haven't established an account, it's much easier for a third party bad actor to go on and establish an account for them. We also have to be aware that, you know, the Department of Labor is looking into this. Auditors are probing practices of our clients and of the service providers. And so I've listed a number of questions or types of questions that have been posed in audits, just for your information, right? Including service provider processes for dealing with cybersecurity threats. So it's bound to happen at one point. So we ought to be aware of and understand how our service providers are dealing with those issues. Authentication requirements, I'll jump. Again, this ought to be standard at this point, right? Or it should be nearing standard. I believe it is standard for some processes, but not all for a lot of the record-keeping firms out there. The life cycle of PII, it's just as important to understand how that information is discarded, you know, once a vendor has it or the company has it. Cybersecurity insurance, so make sure you're looking at your policies to ensure that they do cover these sorts of threats. So let's talk about best practices, right? So what should plan fiduciaries be doing in this space? Well, first of all, and obviously, familiarize yourself with the guidance. It's readily digestible. They really are very straightforward best practices documents that you can read through pretty quickly. Second, evaluate your current service provider practices and contract provisions, right? And I can tell you from anecdotally from my experience working with a number of record keepers, many of them have already been proactive in this area. They've actually looked through the service provider best practices and have responded to each and have provided good documentation summarizing what they're doing with respect to each one of the Department of Labor best practices. So those are always helpful when you're evaluating what your service providers are doing. Certainly incorporate best practices tips in RFP materials. So if you're going out to bid, if you're looking at new service providers, you want to make sure at the front end that they're doing or that they're going through the best practices that the Department of Labor recommends and have actually implemented those best practices. We should communicate online best practices to our participants, right? Consider, you know, most of the record keepers also have pretty robust educational services, right? So we ought to be considering possible educational campaigns around those best practices, updates to the plan landing page and record keeper sites, and then add the SPD. Next, require multi-factor authentication for account access. I will also tell you that from my experience, some of the large record keeping firms mandate multi-factor authentication at login. Some, though, only require it for what they consider high-risk transactions, such as distributions. So at the very least, you ought to have some dialogue with your record keeper about the availability of multi-factor authentication for account access. Consider and evaluate provider guarantees. So many of the record keepers also provide what they call guarantees. So if by no fault of the participant, somebody accesses and steals money from a participant's account, the record keeper will make them whole. I think it's important, though, to recognize that there are limitations to these guarantees, right? So you really need to scrutinize them carefully and also make it a condition in the service agreement. And then finally, consider extending the best practices to other ERISA plans, right? While certainly retirement plans and 401k plans in particular are large targets, right? They're the most cash-rich targets, I think, for hackers. There's really no reason why these kind of best practices wouldn't be at least considered for other benefit plans. Moving on to our next topic, and so this is pretty hot off the press. So just last Thursday, on October 14th, the department published a proposed rule that would significantly modify the rules that they just finalized and became effective earlier this year on investment duties and exercise of shareholder rights. As you may be aware or recall, the current administration actually issued a non-enforcement policy back in March of this year, and essentially said they were not going to enforce those two final rules as they evaluated whether changes were required. And so just at a very high level first, the proposed rule would reverse the chilling effect of the final rules had on reliance on ESG factors. So, and comments on the proposed rule must be submitted no later than Monday, December 13th. So I do want to go in and talk about some of the very significant changes that are being proposed, right? They're not finalized yet, but are being proposed anyhow. So first, let's talk about the investment rule and the significant changes. So the current rule focuses on what the Department of Labor terms as pecuniary factors, which they acknowledge could include ESG factors. But they make it very clear in the preamble, and they made it very clear in the proposed rule that was finalized, that ESG factors should not be too quickly relied upon in making decisions on investments for a plan. So I think most viewed the guidance in the final rule as having a chilling effect on reliance and reference to ESG factors in selecting investments for a plan. So the proposed rule actually eliminates the notion of pecuniary factors and focuses on what it calls appropriate consideration of factors relevant to the investment decision. So let's talk about what that means. So appropriate consideration is the investment is reasonably designed to further purposes of plan, taking into consideration risk of loss and opportunity for gain compared to those of reasonably available alternatives. Well, at least initially, that sounds a lot like pecuniary factors. But then it goes further, and it explicitly recognizes that one of those factors is the projected return of the portfolio relative to the funding objectives of the plan. And this is where it really comes into focus, which may often require an evaluation of the economic effects of climate change and other environmental, social, or governance factors on the particular investment or investment course of action. So very clear departure from the current rule in the proposed rule. So again, they recognize that ESG factors often will be a factor that ought to be considered in making these decisions. And I would also go further and say, and this is not on the slide, the department also provided some additional examples, again, of factors that could be considered to the extent that they impact on the risk return of an investment. And again, they reference climate change as one and other ESG factors, but they also reference other factors such as diversity and equity and inclusion and other factors that could be considered ESG factors in considering an investment for a plan. So very clear departure from where we are with the current rule. The current rule also requires that a fiduciary be unable to distinguish investment alternatives before any kind of collateral benefit could be evaluated to choose one investment over another. So, kind of like a tiebreaker, but essentially, boy, these investments have to be very, very, very close, right? We're unable to distinguish them otherwise. And then we can consider it an ESG factor or other collateral factor in making a decision. But if we do, there are pretty significant documentation requirements that are imposed. The proposed rule alters this pretty significantly. It uses a different threshold, a lower threshold for use of tiebreaker factors. So it says, if the fiduciary concludes competing investments equally serve the financial interests of the plan over appropriate time horizons, then you can refer to other collateral benefits such as ESG factors. And there's really no special fiduciary documentation requirements that are imposed. One caveat though, if we do choose an investment based on a collateral benefit characteristic, we have to prominently display in disclosure materials that characteristic that are delivered to participants and beneficiaries. So I'm not sure exactly how that's going to work out in practice, and that may be an area where we see refinement before this rule is finalized. And then finally, on the investment rule, the other significant change is that the current rule prohibits the use of an investment as a QDIA, right, the qualified default investment alternative, if the investment's objectives, goals, or principal investment strategies include, consider, or indicate use of one or more non-pecuniary factors. And consistent with the other changes, the Department of Labor rejected that and said, no, we're not going to impose that sort of prohibition on a fiduciary because, again, they recognize that these ESG factors may be relevant to a decision. And so they're not imposing any special consideron or prohibition on those. And so we're back to where we were. There's no clear prohibition on use of those factors or a QDIA that references those factors. The proposed rule also makes some changes to the current proxy voting rule or the exercise of shareholder rights rule. First, it eliminates potentially chilling statement that a fiduciary duty to manage shareholder rights pertinent to shares of stock does not require the voting of every proxy or the exercise of every shareholder right. So in the Department of Labor's review, they considered this statement to really have a chilling effect and almost excuse fiduciaries from considering voting proxies, and that they could hang their hat on this language and say, well, no, we don't have to really evaluate this. Really what the Department of Labor wants us to do is shy away from voting proxies because, again, we don't want to use ESG factors. Well, they've removed that language and want fiduciaries to carefully consider whether to vote proxies or not. And also eliminates specific monitoring requirements for managers or firms whom proxy voting responsibilities have been delegated. It kind of reverts back to our normal fiduciary obligations to prudently select and monitor those service providers. It removes certain proxy voting policy safe harbors that were adopted in the current rule. And it also removes the requirements for, any special requirements for maintenance of records on proxy voting decisions to address potential chilling effect of the requirement. So in sum, again, this rule, the proposed rule, if finalized in this form, really marks a dramatic shift from the current final rule and kind of reverts back to our, on again, off again rule that's been kind of the standard for the past, seems 25, 30 years on going back and forth depending on what administration is in place. Finally, I want to talk about the fiduciary definition. So fiduciary definition is also, again, in the spotlight. And again, it's much like the ESG rule, right? Where we've had rules that have been on again and off again for more than a decade. And you may all be aware of the history, but we had a proposed rule in this area back in 2011 timeframe, which was withdrawn. We had the final fiduciary rule that was adopted in 2016, was subsequently vacated by the Fifth Circuit Court of Appeals. And then we had our latest, right? We've reverted back to the 5-part test, which had been around since 1975. And so we had the return of the 5-part test in 2018. And then in 2021, and leading up to it in the proposal and in the final rule, in the preamble, the Department of Labor really changed their view of the application of the 5-part test. And now we have an announcement by the Department of Labor that they're again going to revisit the fiduciary definition. So more to come. We expect this later this year or early next year. But what do we do now? Where are we now? So again, the revised 5-part test currently applies. Planned fiduciaries should reevaluate their service provider relationships as a result of the changes. So really the most notable change in the Department of Labor's interpretation of the 5-part test is in the area of rollover and distribution advice, right? So we had advisory opinion 2005-23A back in 2005 that essentially said, no, rollover advice standing alone is not investment advice. It's not fiduciary in nature. And so we've been living with that opinion for the last 16 years. Would have been altered by the final fiduciary rule, which I mentioned was vacated, but so we've been living with that opinion, and the Department of Labor basically admitted they just got it wrong. They think rollover and other distribution advice is very significant, maybe the most important decision that a participant makes in their kind of investment life. And so they acknowledge that rollover advice very well may be investment advice. And so they've also kind of revised their interpretation of certain of the prongs, right? And so the regularity prong, right? It has to be made on a regular basis. Well, what if advice is given for the first time? Or when you interact with this person, it's rollover advice, it's your first interaction with them and they give you advice to roll over. Well, is that on a regular basis? Previously, we would argue no, right? If it's the first time, then it can't be on a regular basis. Well, the Department of Labor really revised their view of this and said, well, no, if you provide rollover advice with the expectation of an ongoing relationship, that's sufficient to meet the regularity prong. And so again, we don't want to go into the details too much, but just suffice it to say, there were major changes that will cause us or should cause us to reevaluate our service provider relationships and understand how they are reacting to the revised interpretation by the Department of Labor. I should note there is still temporary non-enforcement policy in effect until December 2021. And this really came about as a result of the final fiduciary rule being vacated in 2018. A lot of service providers had already changed their practices and procedures and were preparing to comply with that final fiduciary rule and were relying on the best interest contract exemption. And so the Department of Labor didn't want to pull the rug out from under them. He said, well, no, we need to provide a non-enforcement policy. Well, again, that all ends in December of 2021. And so you may see your service providers come forward and propose modifications to their practices or seek to revise their service agreements, to the end of avoiding prohibited transactions and other breaches of fiduciary duty. So again, we expect the rule later this year, early next year. So again, stay tuned because I suspect we will see pretty dramatic changes in that rule. And with that, I will turn it over to Dominic.
Thank you, Ed. And I now realize that when I turn my camera off, it completely resets. And so if you want to see me a little better, I guess I have to do something like this. So in any case, we're going to talk a little bit more about missing participants here, just continuing with the Department of Labor guidance theme that Ed started off on. And essentially, the missing, hopefully, not too many of you, but some of you have probably already had maybe not so enjoyable experiences with this program, which the Department of Labor essentially refers to as the Terminated Vested Participant Project, but the rest of the world all calls it the Missing Non-Responsive Participants Program. This was actually a regional initiative that started in the Philadelphia office in 2005 under the Bush administration, and it quickly spread to other national offices, essentially, and ultimately being acknowledged by the Department of Labor's national office as a national initiative within the last couple of years. There were a number of concerns raised about this particular initiative, but essentially the way it started out was essentially a survey. Surveys went out and based on Form 5500 data back in 2005, and it was determined that, we think, we being folks in the Philadelphia office, we think there's a lot of money out there, in this case, in defined benefit plans, that is not finding its way to plan participants, not being paid out when it should be paid out. And we think, based on preliminary information from the surveys, and ultimately labor sought to prove that out with their investigations. We think that the reason why these amounts are not being paid out to defined benefit plan participants is because fiduciaries are breaching their fiduciary duties. They have an obligation, fiduciaries have an obligation to provide notices from time to time, to keep in contact with participants, and ultimately, one of the highest duties associated with fiduciaries, obligations is to ensure that plan benefits are paid to participants. Now, there are a lot of interesting and complicated reasons why, in fact, it's true that historically there likely was not, in many cases, enough attention paid to these types of issues by plan participants, or excuse me, by plan fiduciaries. But nevertheless, none of the substantive law had really changed since 1974, and regulations were published in 1977 that are relevant to this. But essentially, nothing had changed from there until 2005, and fiduciaries never had any guidance from the Department of Labor regarding what they should do. So as this project took off and news of it took off, and folks started seeing very long and expensive investigations, essentially, there started to become a clamoring over the years that built up, saying to labor, like, we need something more. We, the stakeholders, the community, need something more in terms of some guidance here. Now, why does labor do this? What are they concerned about, in addition to the general notion that folks aren't getting their benefits? Well, ultimately they point to extremely tangible results in the dollars. You can see on the slide, in fiscal year 2020 alone, Department of Labor credits the program with helping almost 30,000 participants in defined benefit plans collect benefits on the order of $1.5 billion. So essentially what they're saying is, but for our actions with respect to these investigations, but for the awareness that had been brought, and the changes in fiduciary conduct that were brought about because of those investigations, these 30,000 participants wouldn't have received this $1.5 billion. As long as they keep getting those types of results in their investigations, they're going to keep investigating. There's no doubt about it. They had similar recoveries in 2019 on the order of $1.5 billion. It's interesting that that was a significant increase over prior years. You see them listed here, 810 million, 325 million in the prior 2 years. And that indicates essentially the expansion, nationalization, and devotion of resources that labor has had with respect to this initiative. And again, I think they would say the proof is in the pudding. We're collecting a lot of money here, or we're getting a lot of money into the hand of participants that otherwise wouldn't be there. Now, some of you may have seen and experienced a similar type of investigation related to your defined contribution plan, your 401k plan. Though those numbers are not included in here, although we do see these issues in defined contribution plans. And in particular, we see a lot of uncashed check issues in defined contribution plans, which essentially raises the same types of issues. So until recently, as I noted, the Department of Labor had issued no guidance. And essentially, stakeholders have been asking for years and years, give us some guidance. And those stakeholders, ultimately, well, I guess GAO is maybe not technically a stakeholder, but GAO, just like what they did with cybersecurity, basically said to the Department of Labor in a recommendation in 2018, you should issue some guidance. Now, what they issued didn't come out quite as quickly as it did with respect to what Ed described on cybersecurity, 2 months later, which in that case, clearly the Department of Labor guidance had already been far along when the GAO report was issued on cybersecurity. But in this case, this follows a more traditional approach where there's a push and a nudge for guidance, and it takes some time for the agency to actually come up with that guidance. I think further complicating the issue on missing and non-responsive participants, to be fair to labor, is that, unlike cybersecurity, where labor can essentially provide whatever guidance they want to provide with respect to ERISA obligations on their own, they do, of course, consult with the other agencies, but that consultation is not nearly as critical. In the case of missing non-responsive participants, there are significant Internal Revenue Code issues and significant PBGC interests, which essentially requires Department of Labor to do, let's call it consultation plus, to be even more heavily invested in that consultation and ensuring that, you know, whatever it is they ultimately may publish doesn't somehow run afoul of guidance or interests of one of their sister agencies. Another thing to note here before we dive into what this guidance actually said, just big picture, is, you know, the missing participant issue generally is a little different, although in some ways the type of guidance that came out is going to feel similar to what Ed described with respect to cybersecurity. The big picture issue in terms of the relationship between plan fiduciaries and service providers, record keepers, is a bit different. I think in the cybersecurity realm, and what we're seeing, first off, as Ed described it, you know, the guidance that came from labor was in some cases directed straight toward what they expect service providers to be doing. As you'll see in a moment, the missing non-responsive participant guidance is not quite that way. But even more importantly, on the cybersecurity side, you know, record keepers and service providers really have skin in the game in terms of, you know, being at risk with respect to those issues. And they really don't have the same level of risk with respect to missing non-responsive participants, which is essentially really purely a planned fiduciary issue. So turning to the guidance that, you know, was issued in January of 2021, the Department of Labor issued 3 pieces of guidance, and, you know, which basically detailed their view kind of what should be done. Now, the guidance, by just big picture, is very consistent. I described that there's been this historical trend of investigations. The guidance is very consistent with what we've seen in a lot of those investigations. It includes best practices for pension plans. It includes, you know, compliance assistance release, which essentially is it's a transparency. I mean, I think it's basically an outline of the general investigative approach. It's really actually directed toward investigators from the mothership, if you will, from DC national office, but essentially gives a transparency as to, you know, to stakeholders what exactly should be happening in these investigations. So it gives you a sense of how they work. And it also included a temporary authorization of use of the PBGC program. You know, the guidance does not, you know, issue, it's not some bright line test. It does not give a fiduciary safe harbor. There are folks who wanted something very specific in this regard, who wanted, you know, basically, hey, you know, if plan fiduciaries, if you follow, you know, the following list, A, B, C, and D, then you're going to be good, and that somehow you've done everything you need to do. And Department of Labor explicitly refused to do that because, you know, honestly, these issues don't really lend themselves, because the facts and circumstances for every plan is typically a little different. It doesn't really lend itself to being able to do that. So, you know, so here we see, you know, the Department of Labor, as part of their guidance, published these, call them red flags. They call them red flags. I mean, the translation is, if Department of Labor is investigating your plan and they find these issues in your plan, they're going to assume that something's wrong. They're going to assume that the plan fiduciaries have messed something up, and they're going to expect something to happen in response to that. That's what this means. And you can see, you know, basically what those red flags are. More than a small number of missing or non-responsive participants. More than a small number of terminated vested participants who reached normal retirement age but didn't start receiving their benefits, because of course, in general, you know, normal retirement age is the age at which benefits should commence under a qualified plan. Missing inaccurate and incomplete contact information, census data, or both. You know, the absence of certain policies regarding what to do when mail is returned, you know, marked return to sender, or wrong address, or otherwise undeliverable. And the absence of policies for handling uncashed checks. You know, there's no type of journal or record of the uncashed checks. There's a bunch of stale checks out there that nothing has been done. And, you know, essentially, these are the kinds of red flags that they're looking for. So what are some best practices? Well, luckily, the Department of Labor does give some best practices, and they're pretty explicit about saying, you know, hey, we don't mean to imply that every single one of these best practices is something you must be doing as a plan fiduciary. But they give a very, very large laundry list of best practices. And these are actually some of the high level best practices. And under each one of these, there's a number of sub items, if you will, regarding what folks should be doing. So maintaining an accurate census information, for a plan's participants population. So, what types of things are involved with that? Well, they talk about periodically contacting participants, both active and inactives, and beneficiaries to confirm or update contact information. Well, there are a lot of notices that go out in ordinary course retirement plan administration to active and retired participants. And so, essentially those notices could include a request for updates for information, a reminder as to how to update contact information. It's not a guarantee. Obviously, if the notice doesn't get to them, well, then the participant isn't going to be able to update, but it is a step that can be taken. And as we think about procedural prudence from the perspective of whether we're implementing these best practices, to point out to labor in that investigation that might occur, hey, we've done our job. That's one step that can be taken. Labor talks about making it easy for folks to update their contact information, which would include maybe having some link, that exists with every communication that goes out. Maybe having, if there's a website, where folks log in, say in your K plan, folks log in to see their account balances, having something prominent, kind of a call out box or a prominent place where folks can say, okay, I've had a change of address, and then the record keeper can go through its ordinary process and receive that information to verify it and make sure that it's correct. They want to see folks flagging undeliverable mail and uncashed checks and emails and whatnot. And they want fiduciaries to pay particular attention to major corporate events, such as mergers, acquisitions, a change in record keepers. And DOL kind of notes in this regard that well-run plans will make missing participant searches of the plan part of something they do as a regular basis. So that's kind of the first. The next thing that the Department of Labor, and this is actually on the prior slide, that the Department of Labor talks about is implementing effective communication strategies. And in that regard, they're talking about using plain language, offering non-language assistant or non-English assistance, and encouraging contact through the plan sponsor, record keeper websites, and toll-free numbers. They talk about, and they're very focused on stating upfront and prominently when a communication goes out, well, exactly what is this communication about? And they want you to label it with the name of the plan sponsor, but also using the name of the plan. We know that a lot of our defined benefit plans include, prior plans that were merged in, legacy plans that were picked up along the way. And the name of the plan for a particular participant might have been very different at the time they participated. Labor talks about including that name of that plan, the legacy plan, in addition to the name of the plan into which it's merged, the current plan, so that plan participants, have an idea, or maybe it's more likely to spur their memory, like, oh yeah, this is something I should open rather than just throwing in the trash. Labor talks about building in steps in your onboarding and exit processes with respect to employees to update contact information and other. To implement these effective communication strategies really requires working closely with record keepers. And so you kind of have to, any type of third-party record keeper or administrator who you have working with respect to the plan, you really need to work closely with them to ensure that these types of things can be done. Missing participant searches, as we talked a little bit before, this is really the meat of it. The Department of Labor gets into this. They want fiduciaries to be searching regularly using some or all of the following types of steps. They want you to draw on information from related plans. So if you've got somebody who's a participant in the 401k plan and in the defined benefit plan, and somehow there's missing information with respect to that person on the defined benefit plan, then go look and see if you've got that information in the defined in the 401k plan records. They want you to check with designated beneficiaries or emergency contacts. That can be helpful. They want you to use free online search tools. They want you to use a commercial locator service or public databases if possible. They obviously want you to try to connect with people through the last known address. They talk about certified mail. I don't know, the last time I said something certified mail, it took like 45 days to get there. But maybe that's helpful. I've had discussions with folks at Labor about that doesn't seem that helpful to me, but ultimately it's a step that you can take. They also talk about reaching out to folks via text, phone, even social media, searching obituaries and death records, and reaching out to colleagues, which can actually have some privacy concerns that I think many of us would be worried about. I think that all of these steps. None of these things are. There's no exact perfect answer. There's nothing that says, well, if you do these 5 things, as I noted earlier, that you've met all of your obligations. But essentially, the idea is working closely with your service providers to make sure that you're doing some of these and making decisions regarding. And then finally, documenting your policies and procedures. The types of things that you may want to document include guidance for handling unreturned, undeliverable and returned mail, emails and uncashed checks, procedures for conducting regular plan census information audits, procedures and plans for collecting sensitive information during onboarding and exit interview processes, and guidelines regarding what steps will be taken to locate missing participants. So key takeaways, I think we've talked about a lot of these. Be familiar with the guidance. Like the cybersecurity guidance, this is actually not a very difficult read, but it's important to understand. Evaluate your current service provider practices, contractual provisions. Department of Labor, look, you had a third-party record keeper there, and they have their processes and procedures. The acceptable answer from a planned fiduciary is not to say, I don't know what my record keeper does. They have a process they follow. That's not going to work. The answer is, hey, they have a process they follow. We've evaluated that, and our role as planned fiduciaries, and we're comfortable that it's appropriate for our plan. And you also want to take a look at, review, and update contractual provisions with your third-party record keepers to see if there's any gaps, and essentially what are they required to do and what should they be doing. Okay, so now turning to kind of the future, I guess, if you will. We just spent a couple minutes at the end here wrapping up about, well, what are some things that we might see? You've probably heard in the news a lot of talk about a reconciliation bill, which is, or some people call it the Build Back Better law. I don't really know what it's going to get called, but probably most likely something's going to get passed, and it's going to involve a lot of things that have nothing to do with retirement or our area, but it is likely to include at least a few things that do involve our area. So we thought it would make sense to give you a little bit of a flavor of it. Number one is, and this is the most likely thing to be included, in my opinion, is changes with respect to IRAs. I think we've probably, it's usually used as a political weapon. We've heard about people with exorbitant IRA account balances, and people say, how did they get so much money on their IRA? And something must be wrong. Well, generally, people get that much money in their IRA through legal means. Sometimes there may be, questionable valuation issues with respect to when amounts first get contributed. But essentially, folks are following the rules. And now Congress is saying, well, we don't like the rules, and it's their prerogative to change them with the president's consent when he signs. And so ultimately, where this would go, as it's currently structured, is it would essentially cut off any ability for somebody to make IRA contributions if they have combined IRA and defined contribution account balances of over $10 million. It would prohibit certain investments, and we don't really have time to get into it, but also the details there are very likely to change as I understand it, so it doesn't make much sense to go into what's currently in there. And high income taxpayers with large account balances, that's over the 10 million, are going to be required to take a distribution or get smacked with a 50% excise tax. So, well, what does this mean for qualified plans? So that's kind of why we're talking about it. Well, essentially, this is the only way that the government is going to know, and a participant is going to know if they have over $10 million is if they get a report, and the government gets a report that says, here's what you have in your defined contribution plan, your 401k plan. And of course, they already get a report for their IRAs. So this would mean a new reporting requirement. And the way they've said it, at least tentatively, is that the reporting requirement would apply in any case of a person under a defined contribution plan who has an account balance in excess of $2.5 million. that would kick a reporting requirement in. The next way it would affect qualified plans is that there would be a new defined contribution plan distribution requirement. It would be based solely on the participant saying, I'm one of those people with a really big combined IRA defined contribution account balance. I need to take my money. And the answer would be under the qualified plan, if that person comes in, raises their hand and says, I'm affected by this, I need to take my money, there would be a tax qualification rule currently styled in the legislation as 401A39 that would require the plan to provide that distribution, and it wouldn't be subject to the early distribution tax 10%, but it would just essentially be a new distribution requirement. There is an ESOP carve out that allows, essentially it's to try to manage repurchase obligations that allows ESOPs to go last, but essentially, that may or may not help depending upon where, how big the ESOP balance is and what other accounts somebody has. Somebody could have a $10 million account balance right in their private company ESOP. A couple other quick things we'll hit and then we'll wrap up. There are likely to be changes in Roth conversion rules, the so-called backdoor Roth strategy that's been referred to. It was highlighted in a recent Wall Street Journal article. So again, if you want to get something eliminated, just get highlighted in the Wall Street Journal. No, the folks on the Hill and in the policy circles have been aware of this for quite some time. So those basically the backdoor Roth conversions of after-tax contributions would be eliminated after 2021, and then essentially no Roth conversions would be allowed by high-income taxpayers effective as of 2031, and that's really a revenue provision because if you let people do it for the next 10 years, it makes money. And there's likely to be an expansion of the savers credit, which just very briefly is actually essentially a government match for low-income individuals, with the difference being that the credit would, under the proposal, would be refundable. That means that it could go back to participants, but they would have to contribute it to a plan or an IRA. No plan would be required to accept it, but you could. There's also some potential changes to an automatic 401k IRA mandate and changes to accelerate the 162M changes from ARPA, accelerate them by 5 years, and they'd come into effect sooner. And with that, I think I'm done.
Thank you, Dominic. And we are just after 1, so we are going to wrap up. If you would like to apply for CLE or HRCI, please note the attachments in the handout section in the control panel. You will need to print and complete the attorney affirmation form to receive credit or a certificate of attendance. You will need a code to complete the form. Today's code is TH1020. That's T as in Tom, H as in Harry, and the number 1020. Please also spend a few moments to complete and submit the feedback form, also in the handout section. Well, thank you for attending our presentation. As mentioned, we will send out the recorded webinar and slides to all registrants. If you have questions we were unable to get to, please reach out to your Thompson Hine attorney. If you aren't currently a client, contact one of us and we will discuss available options to address your needs. Remember, if you need CLE or HRCI credits, please download and complete the affirmation form and follow directions and use code TH1020. Thank you so much and enjoy the rest of your day.